Imagine this. You are 22 years old, fresh out of college, and you have just landed your first real job. The excitement is electric. You picture your first salary credit, daydreaming about a new phone, helping your family, or maybe even starting a small investment. Then you hear whispers in the office and see headlines flashing on your screen. The government was planning big changes to the income tax rules. These changes were supposed to make things simpler, especially for young earners like you. You followed the news, trying to understand what it all meant for your hard-earned money. It felt like a new chapter was about to begin for everyone. Then, just as quickly as it appeared, the story changed. Finance Minister Nirmala Sitharaman, in a move that caught everyone by surprise, announced that the proposed income tax bill was being withdrawn. The news spread like wildfire across social media and news channels. Why? What happened behind the closed doors of North Block? The promise of a simpler, more modern tax system seemed to evaporate into thin air. It left millions of young Indians from Bengaluru's tech parks to Mumbai's financial district with a single burning question: what just happened and why does it matter to me? This wasn't just a political headline, it felt personal. This sudden reversal is more than just a footnote in parliamentary records. It is a puzzle that reveals the complex machinery of policy-making in India. So what exactly was this mysterious income tax bill that has now vanished? At its core, the bill aimed to achieve one primary goal: simplification. The existing tax code is a labyrinth, a maze of sections, subsections, and clauses that even seasoned accountants find daunting. The proposed bill wanted to tear down some of these confusing walls. One of its most talked about features was the plan to consolidate the old and new tax regimes. Instead of choosing between two complicated systems, there would have been a single, streamlined structure with fewer exemptions but lower tax rates for most people. The idea was to make filing your taxes as easy as ordering a pizza online, or at least, that was the dream. Another key proposal was the redefinition of certain income sources, particularly for the digital economy. Think about it. Thousands of young Indians today are content creators, freelancers, and gig workers. Their income doesn't fit neatly into the traditional salary box. The bill intended to introduce clearer guidelines for taxing income from digital assets, online services, and foreign earnings. This would have brought much-needed clarity for a whole new generation of entrepreneurs. It was a forward-looking step, an acknowledgement that the nature of work has fundamentally changed in the 21st century. The bill also promised to leverage technology to a much greater extent. It proposed the creation of a unified digital interface for all tax-related matters, from filing returns to responding to notices. The goal was to minimize human interaction with the tax department, thereby reducing opportunities for harassment and corruption, a long-standing complaint among taxpayers. For a young person starting their career, it meant less fear and anxiety associated with the word tax. Finally, there were provisions aimed at small businesses and startups. The bill suggested raising the threshold for mandatory tax audits and simplifying the compliance requirements for new companies. This was meant to foster a more vibrant entrepreneurial ecosystem. In essence, the bill was a package of promises: simplicity for individuals, clarity for the new age workforce, efficiency through technology, and a helping hand for the innovators and job creators of tomorrow. The timing of this withdrawal is the most intriguing part of the puzzle. Why now? On August 10, 2025, with several state elections looming on the horizon, the answer likely lies in the complex game of political calculation. While the bill aimed for long-term simplification, its short-term effects may have been perceived as politically risky. Eliminating popular exemptions, such as those for house rent allowance or certain investments under Section 80C, would have been a bitter pill to swallow for the salaried middle class. This group forms a vocal and influential vote bank. Forcing them to pay more tax up front, even with the promise of lower overall rates, could have sparked significant public backlash just before crucial elections. Furthermore, powerful lobbies and interest groups likely played a significant role behind the scenes. Think about the insurance industry, which thrives on tax-saving products like ULIPs, or the real estate sector, which benefits from home loan-related tax deductions. The proposed bill, by removing many of these exemptions, threatened the business models of these established players. These groups have immense influence and are adept at making their concerns heard in the corridors of power. It is plausible that their sustained pressure and arguments about potential economic disruptions convinced the government that the political cost of the reform was simply too high at this moment. Another factor is the feedback from the ground. The government may have conducted internal surveys or received intelligence reports indicating that the proposed changes were not being well received. In a country as diverse as India, a one-size-fits-all approach to tax reform is incredibly challenging. What works for a gig worker in a metro city might not work for a small trader in a Tier 3 town. Faced with the possibility of widespread discontent, the leadership might have decided that a strategic retreat was the wiser political move. It is often said that good economics can be bad politics, and this appears to be a classic example. Ultimately, the withdrawal can be seen as a pragmatic decision to prioritize political stability over immediate, disruptive reform. The government may have concluded that the economic environment was not yet robust enough to absorb the shock of such a significant change. The plan might not be abandoned forever, but simply postponed. The bill has been taken off the table, perhaps to be reworked and reintroduced at a more opportune moment after the political weather has cleared. It's easy to see income tax bill as just a boring headline, something that, only economists and politicians care about. But the truth is, these laws are actually deeply personal. They're like the invisible architects of your financial life. Take, for example, a young person, let's say a 25-year-old software developer named Priya. For her, tax rules decide how much of her monthly salary of 80,000 rupees actually makes it into her bank account. The current system, with its maze of exemptions, kind of nudges her to rent a certain type of apartment just to claim HRA, or to invest in an ELSS mutual fund to save tax under ADC. So, her financial decisions aren't entirely her own, they're, heavily steered by the tax code. Now just imagine how things could have changed for her if the withdrawn bill had passed. Under the proposed simplified regime, Priya might have lost those specific deductions. Her take-home salary in the short term could have been a bit lower, but she would have gained something incredibly valuable: freedom. She wouldn't have to make investment or spending choices just to save on taxes. She could, for instance, choose to invest in high-growth stocks instead of a tax-saving fund, or maybe live in a smaller, cheaper apartment closer to her office without worrying about HRA calculations. The bill, in essence, was offering a trade-off: less guided savings in exchange for more personal financial autonomy. But this impact goes way beyond just the monthly payslip. Think about long-term goals. For someone planning to buy their first home, tax laws are absolutely critical. The deduction on home loan interest can make a property a lot more affordable over a 20-year period. With the bill withdrawn, this status quo remains, for better or worse. It keeps the dream of homeownership tied to the tax code. Similarly, for a budding entrepreneur, the simplified compliance promised by the bill would have meant spending less time on paperwork and more time building their business. Its withdrawal means they're still stuck navigating the old, complicated system, which can really be a major roadblock for innovation. The main takeaway here is that tax policy isn't just about government revenue. It's a powerful tool that shapes social and economic behavior. It influences where you live, how you save, whether you decide to start a business, and even when you choose to get married. For young Indians, especially those just starting their financial journey, understanding these undercurrents isn't optional, it's essential. The withdrawal of the bill is a live case study, a real-world lesson in how government decisions can directly change the course of your financial future. It's a reminder to pay close attention because these rules are, quite literally, writing the story of your wallet. The withdrawal of the income tax bill isn't really the end, it's just a pause. It's a moment for all of us to learn and honestly prepare for whatever comes next. The government's ambition to simplify the tax code hasn't vanished, it's just been put on hold for a bit. For every young citizen, this is a signal, to get more engaged and financially literate. The first thing to keep an eye on is piecemeal changes. Instead of one big, sweeping reform, the finance ministry might start rolling out smaller, incremental tweaks in the annual union budget. So, look out for adjustments in tax slabs, changes to capital gains tax, or maybe the introduction of new specific deductions. These small steps will give you clues about the government's direction. Second, pay close attention to the ongoing conversations around the Goods and Services Tax, or GST. Often, reforms in direct tax, like income tax, and indirect tax, like GST, are closely linked. The government might focus its energy on making GST compliance easier, and could even consider bringing excluded items like petrol and diesel under its scope. As a young consumer and citizen, understanding how GST affects the price of everything you buy is just as important as knowing your income tax slab. The most empowering thing you can do right now is to educate yourself. Don't just wait for policy changes to happen to you. Take the time to really understand the basics of the current tax system. What's the difference between the old and new regimes? What are the most common deductions under Section 80C? How is tax calculated on your investments? There are tons of free resources, apps, and online courses out there. Building this knowledge will transform you from a passive taxpayer into an informed financial citizen, ready to make smart decisions no matter what the government does next. Your financial future is just too important to leave to chance or confusion. Lastly, keep an eye out for the revival of the conversation. The key issues that the bill tried to address, complexity, lack of transparency, and a tax code that's out of sync with the new economy, aren't going anywhere. Sooner or later, the government will have to go back to the drawing board. When that happens, be ready to join the debate. Read the analysis, talk about it with your friends, and really try to understand how it could impact your life. The future of India's tax policy will be shaped by the voices of its young, ambitious, and informed citizens. The curtain may have fallen on this particular bill, but the show is far from over. The next act is coming, and you should be right there in the front row, ready to watch, understand, and act.